Hello, welcome to the weekly chart review. I'm Selena Nicholas, technical analyst at xm.com. Today's January 20th, 2016. We'll start with Euro USD on the weekly chart. The bias in Euro USD has been neutral on the weekly chart since falling to a multi-year low of 1.0461 in March. The pair has been trapped in sideways action within a range between 0.05 and 1.15. In recent weeks, prices have been capped by resistance at 1.10. The target to the downside is the 1.05 level and the multi-year low of 1.0461, which, if breached, would bring a resumption of the downtrend that started in May 2014 from the high of 1.3992 when prices fell down. The bearish crossover of the 200 and the 50-week moving averages and the thickening Ichimoku cloud are keeping the bearish bias strong for now, with RSI below 50. Upside momentum is likely weak. Let's take a look at GBPUSD on the weekly chart now. Cable has started the new year in a very bearish mode. GBPUSD has been making lower lows and lower highs since declining from the June 2015 high of 1.5929. It was declining in a downward channel, and the pair broke outside of it and fell sharply in the first 2 weeks of 2016. Breaching the key psychological level of 1.50 towards the end of last year, it triggered this huge drop, and we reached a new multi-year low of 1.4124. This is a near 6-year low right now. Further declines opened the way to target the 2009 low, which comes in at 1.3503. Market remains below the Ichimoku cloud and below its 200-week moving average, which highlights the bearish market structure. Also, the negatively aligned Tenkan-sen and Kijun-sen lines are adding to the downside bias. RSI is in bearish territory below 50. Any bounces to the upside would meet resistance at this key 1.50 level. The overall bearish outlook is strong as long as market remains below this 1.50 level. Now let's take a look at the EURGBP on the weekly chart. EURGBP has had a good run since bouncing from the low of 0.6981. This was a November low, and it rallied up to the 0.77 big figure. After successfully rising above the Ichimoku cloud, the pair reached a 1-year high of 0.7755 today. It appears that there is an inverse head and shoulders pattern forming. This is usually a trend reversal pattern. The neckline is at the key 0.75 level, which comes in around at the top of the Ichimoku cloud. Prices are currently finding support at the 38.2% Fibonacci level, and this retracement level is of the down leg from the high of 0.8813 back in December 2012 down to the July 2015 low of 0.6935. If the market pushes higher from current levels towards a 50% Fibonacci, and if it breaches a 0.80 level, this is another key psychological level, then there would be a shift in the trend to more bullish bias. Now let's take a look at USDJPY on the weekly chart. You can see USDJPY failed to hold above the key 120 level and breached this level at the start of this year, and prices have fallen below the 116 level briefly today to a low of 115.96. The underlying outlook is bearish, and there is scope for deeper falls. We can look to Fibonacci levels for support. These retracement levels would be from the rise from 75.55 to 125.84. So the next Fibonacci level below current price levels would be the 23.6 Fibonacci at 113.92. Looking at technical indicators, Tenkan Sen, which is the red line, just recently crossed below the Kijun Sen line. This is a bearish signal, and RSI is falling. It's below 15 bearish territory. But overall, we would need to see stronger bearish signals to show a change in the current bias. We could say that it's the bias is still neutral in consolidation since the end of 2014, all throughout 2015. The market has been consolidating around this 120 level. A break above the high of 125.84, this high was reached in May 2015. A break above this would bring back the uptrend that started from the 2011 low of 75.55. Thank you for watching and have a great day.